Well, again, I mentioned one of the advantages of being in this community for a long time is that I've met some of the best in what they do. And years ago, literally over 30 years ago, I looked at my notes and I met our next speaker. He was a partner with another outstanding CPA who's since retired. But Steve is now one of the senior tax partners in Hutchison and Bloodgood have 4 different offices. So, and they're involved in everything from the commercial side of, you name the large companies, large businesses, including some public companies as well, and all the way out to the agrarian side of things. They've got an office out, is El Centro? Is it in El Centro? So they're dealing with some of these farmers and, the big tractors and all that stuff. So talk about a diverse group of tax and other type of accounting, everything you can have, but in these 4 offices. So it's been fun to watch Steve's career. He got snapped up by Hutchison Bloodgood to be one of the senior partners. And so as we were putting this together, I thought, okay, who can I go to that I trust them? I know they know their stuff. And I'm telling you, this new tax bill, my in-house attorney and I finished doing an article on this qualified business deduction, and after we finished writing the article, we still looked at each other and said, what does this say? So I finally said, Steve, would you please explain this to us? So without further ado, I want to have you come up, Steve Throop, Hutchison Bloodgood. Thanks, man. Good to have you with us. I can't wait to hear how it works.
Well, it was hot topic, so I decided to, the Tax Act is clearly a hot topic, and then the idea is that there's other food for thought I thought I would throw in there. And as far as the Tax Act goes, of course, it's so comprehensive, and there's a real reason that most of these acts are referred to as the Full Employment Act for accountants. And so it just doesn't go quite that simple. So we're trying to get down to what part I should know. I was going to touch on entity choice, because entity choice, it's a legal issue, but it certainly comes into play significantly in tax. State and international tax issues. We often think about our income tax, only our income tax here, but businesses now are expanding so extensively that it's not just California, it's just not the US. Revenue recognition, there's big things on the plate. I do a lot, one of the things I do is I blend between financial reporting and tax. A lot of times you'll find a CPA it's a tax person and I know nothing about financial reporting, or they do financial reporting and they twitch every time they hear the word tax. So uniquely, I've kind of, through my career, kind of switched departments, and then I've maintained that blend, which helps when you're understanding the business and also then understanding the tax implications. And then I have something just as a pricing reminder, because sometimes we all think that it's terrible to pay tax, but the biggest way to avoid tax that I've found is make no money, and that's not a good option. So we also want to see how we can make more money. So what happened with the Tax Act? Essentially, the act cuts rates. That was a lot that was touted, but then we also heard a lot that it cuts deductions. So it's hitting from these two sides, and some people win and some people lose just on the bare plate. So interesting, as we're doing tax returns this year, our program will say, well, what if you had what if your 2018 income and deductions were the same as 17? Would you have come out ahead or would you come out behind? So we have that off the top calculation, and we've seen, again, some win, some lose, and that's the thing. So what's happened? So the first part, like we said, the first part is rates. So and I think many of us have seen all this, so we're trying to get a perspective, not get completely into the weeds. But the top rate, of course, went down from 39.6 to 37. And corresponding rates went down all along the line. And then, apart from that, and that's on individuals, and then, as RJ alluded to, there's this qualified business deduction, possibly one of the most complex part of the act. And why is that? The idea was, I think the idea was to spur jobs, impact business, and the part we really know is that the corporate rates, if you see, went from 34 to 21. Well, if you just change the corporate rates and reduce the corporate rates, then you would think, well, everybody would just say, I don't want to be an S corporation or I don't want to be an LLC. Let's all just become C corporations. And because if it tilted the advantage that much. So what's happened with this qualified business deduction, it essentially, I look at it as a rate adjustment because it is a deduction, but we'll get into just how that applies. It really, conceptually, it's a reduction in rates is why I listed it under rate reduction. Now, the other thing that's come into play in the last number of years is net investment income tax. Very significant part of an individual's tax liability, and that's when you add up all of your investment income as defined, excuse me, and always, that's the other thing about tax is I can say a word, and if you go to the dictionary, good luck, it's not going to let you know its implications in tax law necessarily. So the net investment income tax is still there. So that's 3.8% on this whole category of income that is just, and it's still there, so that has not reduced. And that varies by your business structure, et cetera. The alternative minimum tax, excuse me, the alternative minimum tax many times kicked it into individuals. So in the past, you might say, we'll touch on, we're all familiar with the state and local tax deduction. Oh, that's going away. Well, very often, at a lot of income levels, you could claim a deduction for your state and local tax, but if it got too much compared to your income, et cetera, there was another tax calculation, the alternative minimum tax calculation. So we didn't just calculate your taxable income and tax. We would also then do this other calculation on the side and say, oh, sorry, your tax came out higher, therefore you pay the higher tax. And a big factor in that was state and local taxes weren't deductible for this other calculation. Again, simplicity abounds, I understand. And then the corporations, of course, the rate went from 34 to 21. But I might mention also there, keep in mind that many people were a C corporation, letting the corporation be taxed. But if they were keeping their income below $100,000 down to $50,000, they were leaving a little bit of taxable income in the corporation, they were paying a lower tax rate than the 21. So was it an increase? Was it a decrease? That depends on everyone's individual situation. So quickly, state and local tax we touched on, it's limited to $10,000. Another big one that hits a number of people is the miscellaneous itemized deductions. So where does that come into play? A lot of people with money management fees, investment management fees, they were coming as an itemized deduction, gone, no deduction. And that's where we're seeing a lot of people that are a loser. It's the state tax deduction is one portion, but some of those same people may have significant money management fees, advisory fees, those are gone. Tax preparation at an individual level, things like that. Employee business expense. So when we have some people getting wages and they might have I'm an employee, I have some other expenses, that's where that went, gone. And many of these, so it might be, one thing was touted was simplicity, because now we don't have to worry about adding up all these deductions, right? Except California hasn't changed, and most of us are filing a California return. So it hasn't necessarily simplified preparation for any of us at this point. The personal exemption is gone. Alimony is varying, just as some highlights. So alimony is going to change, so any divorces after 2018, you have to be very careful with your expectation of whether alimony is deductible and taxable.
Steve, you said the personal exemption is gone. I think you meant to say the personal exemption has doubled. Are you talking about the personal?
The personal exemption for the personal exemption for me or the other taxpayer or children. The personal exemption is gone. Okay. There's a standard deduction that's more or less double.
Okay.
Yeah, good clarification point. And some of that would be perceived to take, to help cover that personal exemption. And in the past, that personal exemption at high income levels was phasing out. So, was it there before? For some people, yes. For some people, no. So other key things, there were a few more deductions were eliminated. Net operating losses, if you have that, needs to be really thought about and addressed, because going forward, now it's only 80% of it can be carried forward, and there's limits and exceptions. Business losses doesn't come into play in many cases, but in large situations, you can be capped at $500,000 or $250,000 from a business loss. So if you have a significant loss passing through from a business, that can be limited. It would be carried over. So not very often, we don't see them a lot, but sometimes you think, well, I have this huge loss and it's going to offset this other income. Not so much. Business interest, again, very isolated at first. Boy, your heart rate can really get impacted by these when you see business interest is limited and everything else, and then you go, oh, over $25 million in gross receipts. Okay, that narrows the applicability a little bit, but it kind of gets the blood running until you read that next paragraph. Meals and entertainment, there's a lot of interest in that. Entertainment expense is heavily just gone down to zero. The meals portion of that, there are some more limitations that are kicking in, and there's a whole handout in the folder to show, and the highlighted part is what has really changed, and it shows whether it's 100%, 50%, or zero taxable. So that's important. A couple things did go up. Again, investments in assets, et cetera, were improved. So those often, they go up and down with every tax law that's played with, but both the asset write-off is increased and bonus depreciation is back to being able to write off 100% of assets. Now this qualified business income deduction. As RJ and I were talking at one point, I think it's interesting that what everyone has heard about it is that this doesn't apply to service businesses. And that is heavily true, but like a lot of things, I've looked at flipping it and saying, okay, what's the basic rule? And then it's been for years, and things at higher income levels get phased out. So realistically, the general rule is you get 20% of the qualified business income, but there's a calculation if you have capital gains in there. There is a limitation based on taxable income. So these are all specifically unique. And for a number of years now, the tax law could not be as complicated as it is, I believe, without computers. And so it's just not safe to do this in your head or to say, oh, I'm going to get this, because what you get on one hand gets taken away somewhere else. So often the question is, can I deduct something? Yes. Will it save you $1? Let's really think that out. That's a whole different question of whether it's going to save you any money. So with this 20% on the overview, the reason I said it's a rate reduction is the maximum rate at 37% becomes 29.6 for federal. Again, no change for California, so this is not coming into play there, but it's really the equivalent of a rate reduction. So that means if you have eligible taxable income, and if you manage your taxable income, as long as that is under $315,000 joint, all these other limitations don't kick in. And I think sometimes we started focusing on the limitations before the income cutoffs. So, what in 157,005 non-joint. So sometimes there's things that can come into play, especially if you're on the edge there, et cetera. Employee benefit plan, deductions, timing things between years, various planning opportunities can come into play, which can allow that 20% deduction. Now, many of the entity structures require that you pay wages, and the whole point of this was not to allow this beneficial rate for what's really earned income, by your own services. And so that's why it kicked out a lot of service businesses, and you still, in many cases, have to pay wages. So another planning opportunity in some cases is, what do you take as wages? What can flow through as business income? Done it for years. People have always tried to say, on an S corporation, I own it and I'm an employee of it. I want to make my wages as low as possible because it's more beneficial to have the business income. Well, that's coming right into play again, big time, has another focus on it. So there is a need for wages, so some of the things we have to carve down in a particular situation is how much is paid in wages, how much is passed through as income. So now if the tax, and it does, by the way, phases out, so it isn't, there's not an exact cliff at 315,000. Through 415,000, you get a partial, just to keep it nice and simple. Of course, it phases out through 415,000. After that, all these specified service businesses, and it names another, accountants are certainly eligible to be specifically named, but once it names attorneys and accountants and a number of different professions, then it says, and any other business where the services of the owner or key employees or something are a principal source of income. So that is, you can imagine there could be a lot of discussion and debate about that, and there will be, I'm sure. So that keeps it interesting. So after that, and these are the ones that, again, many of us focus on, the service businesses go away, but there was another intent within this that if you had an S corporation making just tons of money, passing through all sorts of income, and it's selling widgets, so it's very eligible business. But the idea was if you don't have a lot of wages, you can't have this beneficial deduction. So it's limited to 50%. You take the 20%, and then you say, does that exceed or is that less than 50% of the W-2 wages? And so that can just plain limit it. And so that's where we can look at if we're on the cusp and we have a business owner, could they take more in wages, which would up the limitation amount, but they're also losing business income, so it takes a calculation to see if that's useful. And then at the last minute, it was thrown in heavily for the real estate business because there might be a lot of management companies, et cetera, that don't have tons of wages. So the idea was there's a backup, 25% of your W-2 wages plus 2.5% of the cost of your machinery, equipment, real estate, et cetera. So that's another backup plan to test it against to see which is better. And I mentioned a number of the planning opportunities. So what comes out of that sometimes is, should I be one of these pass-through businesses? Should I be a C Corp? Should I just say, I just want to get the base? And so that should be reevaluated on an ongoing basis. And I think sometimes we've just gotten used to, I am this, and not continually re-explore that. Now, what I've seen in looking at it, some of the considerations are looking forward at least 5 years, because between a C Corp and an S Corp, because you can, that's an election, so you could change and there's some restrictions. Generally, when you're selling your business, if possible, it's great to have been an S Corp. So, and some of this has to do with how soon the revenues are going to flow. If you're operating as an S corporation and you are unable to distribute a lot of that taxable income because you're building equity, you're paying down debt, or something like that, so you can't take the money right out. With those entities, you're paying tax immediately, but you're not getting the money. So when you really go through it, if you're a C corporation, you're going to pay 10% less. If you're an S corporation, for example, you'll pay 10% higher. Basically, that's almost the target. In many cases, it falls around 10%. You're going to pay 10% higher because of the double taxation of a C corp. So is it better? And then the rates of the other entity. So that's what we have to play. And the other thing that comes in critically is when and how am I going to exit this? If I'm expecting to get a big payoff, you can end up with double taxation, or you're stuck with having to sell the stock and the buyer has to want to buy the stock. So we get into the exit planning aspect of that. So switching, and at the end, if there's any questions of that, or probably afterwards, we can go into a little further, because that is a very complex issue. But we're seeing tons of issues with state taxation. And businesses are expanding all over, number one. Number two, the states are getting very aggressive. Again, computers are facilitating their finding, identifying businesses that may be taxed there. So I said state nexus, who's the boss of me? That's like a 5-year-old, you're not the boss of me. And we can say that to a lot of the states, but the states are getting very creative in how they figure that you stepped on their soil one moment, or one of your employees did, or even an independent contractor that it was solely making a market for you in that state. And if the Supreme Court just came down with a decision that's going to be, I think, very impactful on the sales and use tax, which was the Wayfair decision, if you heard of that, and they said South Dakota, I believe it was, has the right to tax. There's business activity type reasons for them having the right to tax, so they can tell a business to collect sales tax. And what we see is if income tax is one thing, that's problematic. Sales and use tax, incredibly costly. And whenever you go to sell, if you don't address it yourself, it's on the due diligence checklist. So we're often working, we have to consider this in preparation. You have to do a risk analysis. Again, a lot of times we don't take the approach that you have to do everything that's said. You have to have a good reasoning, make sure the amounts are small. So sometimes we do a risk analysis and say, these states are going to get you. These states less apt to. You have very low volume there, so we don't immediately go, okay, pay tax in all 50 states. Income tax reporting is, just for general understanding, is sometimes we'll say, well, I'm not earning any money in that state. Well, the way most states work is you figure your total income and then the pie is shared based upon various apportionment formulas. So you can't manage that just by saying, well, I made all my money here, not there. And there's no statute of limitations if you don't file. So this is a critical area to get on top of. International reporting is another one where our office and our firm are very actively involved now. And there was incredible additional provisions in the new Tax Act for that we don't necessarily think about. But for years now, there's been a step up in just reporting. It's not even income tax reporting, but you're doing activities, you have a responsible to report, and generally penalties start at $10,000 per occurrence. So we have to be very careful, and that could be late filing. So if you don't extend your return, file your return late, now you're late on these forms, and now $10,000 potentially per. Repatriation is a big thing we're working on right now. So if any way, shape, or form you have control or ownership of a foreign entity, and it may not even be direct, we're finding indirect control where because of a corporation that you own or control, or you and a few people control, you have overseas income that has not been taxed. There's a repatriation tax to bring it back to the US now, all part of the new act. So that's a key thing. Revenue recognition, just as a thing that's out there, this is not specifically tax related, but it's going to impact business taxes because there's always a question of when do you report revenue on your financial statements, and it's not when you bill. There's all sorts of concepts going into it to match revenue and expense, and when should you be recognizing the revenue. So most businesses, we're starting with many that we're having to go through and evaluate what do the rules say, because the concepts are changing. It's corresponding with international financial reporting, and so that's coming up as effective very quickly. So one last topic that I thought I'd throw in is, we always wrestle with, and we sort of know it, but one thing I've seen, and there's an excerpt from an article in your handouts that talk about pricing, because one of the most important decisions we make is about pricing. And one would think if you're talking to an accountant, the first question would be, what is your cost? That would help you decide your price. But we think about it differently, because cost in a way has nothing to do with your price. They're totally independent concepts. Clearly you want to make sure your cost is below your price, but pricing is between you and your customer. Cost is between you and your vendors. You're in the business of balancing the two. So does it make sense? Is it a good business strategy to use discounts? And is it a good strategy to increase your prices? So one of the things I've laid out there is, I've always found this table very interesting in that it has a table for various margins across the top, and a potential discount down the side. So what this says is if you decide to adopt a discount strategy, you're going to beat your competitors' price and you are 10% below them and you have a 30% margin, your business volume, widgets you sell or hours you bill or whatever it is, have to be 50% higher. So that kind of blows you away that a 10% discount could require that you increase your volume to the extent of 50%. So you go, okay, maybe I shouldn't discount. The next thing is, but aren't we all concerned about raising prices? And if you start to get inflation, you're chasing it. What happens if you increase your prices? So using that same 30% margin, and if you increase your prices by 10%, you could sell 25% fewer widgets, fewer hours, fewer whatever you're doing to maintain the same profit. And so that the table kind of goes into various other levels, but conceptually, food for thought. So if I talk fast enough, we could have questions, but otherwise, see me after, and I think we'll keep the program moving at this moment. Thank you.
Thank you, Steve. Okay, very good, thank you.